Oh my goodness! The financial world is currently grappling with an escalating crisis, and its significant tremors are being felt across global markets. Following a weekend of intense and continuous strikes between Israel and Iran, oil prices have surged dramatically, and global investors are bracing for continued heightened volatility. This rapidly unfolding geopolitical turmoil is unequivocally creating an adverse shock to an already precarious global economy, directly impacting growth forecasts, inflationary pressures, and the critical policy decisions of central banks worldwide. On Friday, Brent crude futures, recognized as the international benchmark, concluded trading more than 7% higher. This notable jump was described as one of the sharpest two-day increases in oil prices observed in recent years. The upward trend continued into Monday, with prices initially climbing another 0.5%, reaching toward five-month highs. Simultaneously, U.S. West Texas Intermediate, WTI, also experienced a significant rise, jumping over 3% on Sunday to hit 75.67 per barrel. The immediate reaction of the markets underscores the profound concern over potential supply disruptions. The conflict has involved direct targeting of critical energy infrastructure. Israel launched coordinated airstrikes on Iran, hitting key facilities. These included the Shaharan fuel depot in northern Tehran, which is a vital distribution point supplying approximately 8 million liters of gasoline daily, and Iran's Shareh oil refinery, one of the country's largest. These strikes resulted in massive fires and the destruction of at least 11 storage tanks. Israel also reportedly struck a section of Iran's South Pars gas field, specifically Phase 14, temporarily halting its production by around 12 million cubic meters of gas. In direct retaliation, Iran reportedly launched drones and missiles, causing damage to the Haifa oil refinery in Israel. Semi-official Iranian media also reported that the fourth phase of Iran's operation against Israel had begun, with Iranian officials vowing a firm response to any Israeli adventism. A paramount concern for global energy markets is the potential closure of the Strait of Hormuz. Iran has explicitly threatened to shut down this crucial waterway. This strait is strategically vital as nearly one-third of global seaborne oil trade and 20% of the world's oil and LNG pass through it daily. Such a closure, if it were to occur, could send oil prices soaring significantly, with some analysts predicting prices could rise past $100 or even $120 a barrel. However, there is some skepticism among analysts regarding Iran's sustained capability to maintain a full blockade. This is largely due to factors such as the formidable presence of the U.S. Navy's Fifth Fleet based in Bahrain and the considerable reliance of major global customers, particularly China, on the uninterrupted flow of oil through this waterway. China is in fact the primary destination for Iranian oil exports, and nearly half of all crude oil passing through the strait, whether Iranian or not, is destined for China. A prolonged blockade would therefore be exceedingly difficult for Iran to sustain, especially under pressure from Beijing. On Friday, U.S. stock markets reacted sharply to the initial attacks and escalating tensions. The Dow Jones Industrial Average plummeted 769 points, while the S&P 500 fell 1.1% and the Nasdaq Composite lost 1.3%. These significant declines pulled all three major indexes into negative territory for the week. Despite this, early Monday trading showed some unexpected resilience in global markets. Dow Jones, S&P 500, and Nasdaq futures all edged higher. European stock markets also opened with modest gains. This surprisingly muted response suggests that some market participants might be interpreting the conflict as potentially limited in scope, particularly since Israel strikes targeted strategic capabilities without directly hitting Iran's key oil export infrastructure. Financial expert Kenny Polcari of Slatestone Wealth even predicted a bounce back in the stock market. Unsurprisingly, sectors directly linked to energy and defense have seen gains amidst this heightened uncertainty. Companies such as ExxonMobil and ConocoPhillips saw their stock prices rise, benefiting from the leaping price of crude oil, which indicates bigger potential profits for them. Defense contractors, including Lockheed Martin and RTX, also experienced increases, with RTX's stock gaining 3.2% to bring its year-to-date rise to 25%. Other defense stocks like Archer Aviation Inc., Rocket Lab Corp., and Axon Enterprise are highlighted for strong revenue growth prospects. Conversely, sectors highly sensitive to higher interest rates and consumer confidence, such as travel and airlines, suffered sharp losses, with Carnival, United Airlines, and Norwegian Cruise Line holdings taking notable hits. This geopolitical turmoil presents a significant and multifaceted challenge for the Federal Reserve. Rising oil prices are inherently inflationary, inflationary, directly complicating the Fed's ongoing deliberations regarding interest rates. Economists, including Mohamed El-Erian, economic advisor to Alliance, are warning that this constitutes an adverse shock to the global economy, likely leading to slower global growth and increased inflationary pressure. The Fed had already demonstrated caution about cutting rates, influenced by the unpredictable impact of U.S. tariff policies and a remarkably resilient labor market, as evidenced by better-than-expected jobs data in May, where employers added 139,000 jobs and the unemployment rate held steady at a low 4.2%. Now, heightened Middle East tensions further reduce the likelihood of immediate rate cuts. Experts like Robert Sakin, senior global economist at Citibank, suggest that if oil prices remain durably higher, a rate cut would likely be pushed to the end of the year. Some expectations point to the first Fed cut potentially occurring in the fourth quarter of this year, possibly a 50 basis point cut in December. The European Central Bank faces a similar dilemma, as higher energy costs could lead to stagflationary pressures in the Eurozone, with a 20% spike in energy prices potentially cutting growth by 0.1% in 2026 and 0.4% in 2027. In times of elevated uncertainty, investors typically seek the relative safety of safe haven assets. Gold prices initially surged, reaching near all-time highs, topping $3,400 per ounce on Friday. However, gold later paired some of these gains on Monday, perhaps signaling a slight easing of market anxiety. The U.S. dollar also saw some initial strength as a safe haven, though its rally has been somewhat contained, with some analysts noting that it has lost some of its safe haven due to U.S. domestic factors. Treasury bond prices fell on Friday, which pushed up their yields, partly due to worries that a spike in oil prices could drive inflation higher. Beyond the direct conflict, other significant economic data points remain in focus. China's May retail sales figures were released on Monday, showing a stronger than expected 6.1% year-on-year jump. However, this positive retail sales data was somewhat offset by slower growth in industrial output, which rose 5.8%. Stronger Chinese data can sometimes lift the Australian dollar, as China is Australia's largest trading partner. Despite this, the AUD-USD pair weakened on Monday, influenced by the escalating geopolitical tensions and a stronger U.S. dollar. The value of the AUD is significantly driven by factors such as the level of interest rates set by the Reserve Bank of Australia, the price of its largest export, iron ore, and the overall health of the Chinese economy. The trade balance, representing the difference between a country's export earnings and import payments, is also a key factor. Markets remain in a distinct wait-and-see mode, closely monitoring the conflict's trajectory and upcoming economic data, including manufacturing surveys and the highly anticipated Federal Reserve interest rate decision later this week. While the market's resilience so far has been notable, the risk of further escalation remains substantial. Analysts from CMC Markets warn that if oil prices surge past $100 per barrel again, Germany could face the threat of recession once more. Geopolitical instability introduces a layer of uncertainty that profoundly resists easy quantification for predictive modeling. Stay informed as these critical developments unfold, directly impacting global trade, inflation dynamics, and your investments. Thank you for tuning in.